All right, just want to pop in with another just quick example of how powerful the banker's strategy is. All right, when you know what the banks are doing, it's so easy just to ride their coattails, all right? And this candle right here is a candle that we call and teach about. It's called the banker's candle. All right, it's a candle that the banks create to take out liquidity, and then they turn and run price the other way, right? It's the last candle before the opposite move. So in this situation, the last up candle before a down move. All right. So when this happens, we start getting excited, but we don't call this a banker candle until it's not a confirmed banker candle until we have breaker structure, right? So price comes down and it breaks structure. So now that is a confirmed banker candle. And we know with a high degree of accuracy that price needs to get back to that candle, because in order to create this candle, they had to put in a bunch of buy orders, right? To take out liquidity, right? Take out money, take out highs, right? And when price turns this way, they're in drawdown on that candle. All right, could be hundreds of millions of dollars. They need to get back to that candle. So we draw our sell limit right here, right at the open of the candle. It comes down and breaks structure, and it comes right up, and look at that, almost no drawdown. They come up and touch that candle, get their money out, and then boom, head down in that direction. Now your take profit is always, in this example, the lows. And it's better if you can have equal lows. We don't have those yet here, but we have a low. And why? Because people buying this would put their stop losses underneath the low, and the banks can see it. They have access to the order books. So they're going to come and get that money, right? And you can see what they did here. They're even smarter, right? Watch this. So they go up and they come down and they stop it right there, creating equal lows. This gets retail traders excited, right? Because they're seeing this big W, right? They're seeing this W, which is a buy pattern, right? And they're thinking, man, we're going to go buy. So the banks real quick create liquidity. They create it, right? I'll take a little dollar sign here and put it right underneath there, right? All this money is piling up, because the retail traders are going to buy this thing. And the banks set that trap perfectly. People put in their buy orders, right? And then they turn around and they wipe it out, right? But we didn't get into any of that mess because we sold here. And if you took it to that low, you get almost a 1 to 3 risk to reward. That means for every 1% that you risked, you would have grown your account by 3%. So if you did the typical 2% that most people do, that's a 6% growth on one single trade. And all because you knew where the banker candle was, and you just rode the bank's coattails down in to take a profit. All right? These trades happen every single day, any time frame, any